Welcome to the Millionaire Journey Podcast. The goal of this podcast is to guide and empower you on your journey towards financial independence. Here's your host, Len Yaney.
Today, my guest is Jeff Ervick, founder of Valoris Capital Partners. Jeff is the first ever returning guest. If you'd like to hear his full story, you can go to episode 46. And I'm glad to have him back. Welcome, Jeff.
Awesome, man. Hey, I'm very excited to be your first returner, right? Your first returning guest on your podcast. That means I guess I did something good the first time. So looking forward to this one.
Well, I like to see, I put a post this weekend about it, but it was Jeff's best of both worlds. He's got high income, W-2 income earner. He's a limited partner. He's a GP also in other deals. And hearing his feedback on everything is always good.
Oh, well, I appreciate that, man. Thank you so much. I mean, it's one of the things where, I know you might be saying that about me, but I'm thinking about the same as you, right? Being that you're, what you're doing with all the mobile homes and everything, it's amazing. It's actually one asset class that you and I should probably figure out how to partner on, because it's one asset class that I love and that I'm just not in yet, right? So
yeah, it's one of those. It's hard. What I'll tell you about capital raising and experienced operators is because I have another friend, Randy Smith. We work together. He helps me with my coaching on really just business, and we meet weekly. But I
was actually on Randy's podcast last week, by the way.
Oh, great! I told him he needs to get you on. Yeah. And but so with Randy, he went to go look for mobile home operators, and there's a certain thing with these the fund to fund models where they have to have a certain level of experience, and with mobile home operators, it becomes where if they have the experience that people are looking for, like that high level, 20 years of experience type of operator, sure, it turns into that person doesn't need capital anymore. And they're not looking for any more because there's not enough deals, is what the short story is. And I could see us kind of going in that direction personally, but it's, we're always looking for capital, but at the same time, it's there's lots of money chasing not enough deals in the mobile home world, and that's the hardest part about investing with those long-term investment capital partners. There's a guy I met at Seco. It's a real mobile home conference, and he was saying, I asked him, "How do you raise capital?" He's like, "Well, I just make a few phone calls, and
there it is.
It usually gets funded within an hour."
Well, I mean, that's when you can get to that point, that's kind of the best part of it, right?
Yeah.
When you know that you've got a deal under contract, and all you got to do is make a couple phone calls, and your investors are, "Hey, let's go, let's jump in, let's do it," right? So we're all getting to that point, right? It takes some time, takes a lot of hard work and a lot of extra hours, right, doing it, but eventually we'll get there. So looking forward to that point, right?
Yeah, definitely. And I think with the one thing I've noticed about Jeff is that he's a very systematic guy. He's got his W-2 that he's managing, and then also he's got the raising capital with his own investments as well. And the reason why I brought him on to today's call is we're just going to talk about kind of his thoughts on the economy and also future deals of where he's putting his money, and it should be interesting.
Yeah. I mean, it's definitely a strange time out there, right? Yeah. There's depending on when this comes out, right? There's a lot of different obviously political, geopolitical. Yep. It's a lot of different things with the tariffs. The market's kind of all over the place. They decided not to drop any rates right now, so that's kind of riding by. Inflation's kind of creeping around the same 3-ish % sort of thing, right? So there's just a lot going on, which the market hates uncertainty, right? So especially the equities market, the stock market, right? There's a lot of algorithm type of investments going on, and it's the problem is that that's not a human emotion, right? There's no human emotion saying that, hey, I know what is going to happen. It's going to be a little fluctuating, but we're going to stay in the market because I know we're going to ride it out, right? And now it's more based on they have these different AI models and different things that kind of don't read that emotional. They basically can't read the room, right? They can't read the room to say hey, I shouldn't be pulling all my stock out, right? Or I should be pulling my stock in, right? Because it just it makes it a weird time, right? Yeah. So with that being said, I feel like it's actually a good time, right, to be able to invest in different type of alternative assets, right? Not just your traditional, let's go buy an apartment complex, or let's invest in mobile home parks, or this and that, right? There's different styles or different assets within the real estate space that I feel like are a little bit more secure right now, where people could probably put their money in and feel comfortable and know that they're going to be able to get a good fixed return. But the hard part is there are so many sweet deals you see out there, right? There's a lot of operators out there that are putting out good opportunities, finding good deals. So, if you know where to look, you're probably got to still have a good opportunity to invest in something that's going to get you good double digit returns, right? And I see that's where the market's also heading. And again, all of the stuff going on politically is you just kind of have to almost phase that out.
Yep.
Right. Because whatever's going to happen is going to happen. And, you just got to figure out and make sure you're doing what's important for you and your family and your investment portfolio to hedge against anything that could, obviously be a negative downside. Right.
Also, the thing about media and what you're reading is we're all on different fields playing right now. We all have different goals and different outlooks. And, what I would say is that for me, I like, I like private lending, and then I like mobile home parks, of course. So I always ask, how is this going to affect mobile home park world?
Yeah. Sure. I mean, it's your main driver, right? So you got to figure that out.
Yeah, and it's going to be probably about the same, if not more demand. And then with private lending, it's always like, are you secured in your position on that asset to make sure that you're protected from the downside?
Yeah, I mean, I think that's a great point. I mean, a lot of like I said, in your world, right? A lot of operators, like when you go to buy a mobile home park, you really can't go to a bank and say, hey, can you lend me a couple $1,000,000, right, for this park, right?
Yeah.
Because the banks are kind of a little uncertain about it, right? So you have to go to a private lender, right, or a private credit in order to be able to get a faster loan operator or faster loan, right, and get somebody who can understand the real estate aspect of it, right, be able to underwrite that correctly, and be able to just speed of time, right? I mean, if that makes sense, but it's what allows you to be flexible and more faster, and then you can understand your predictable return that you can then make after you eventually stabilize your property, refinance it out, and move on to the next one. And on the same token, if you're the private lender, right, you know that you're getting some type of fixed return, right, because you've got an asset backed, whether it's in a first lien position or you're in a subordinate position. If there's a larger debt on it, right, you've got a way to be able to know that you're getting a fixed return on your investment, and then eventually it's that person will either refi you out, right, or it's or you get to experience a longer term hold, right, and right now you can't. It's funny. I was actually thinking about bringing it up to you, but I got this flyer in the mail from American Express, right, and it said, "Hey, here's our new high yield savings account. It's producing a 3.75%." I was like, "Oh man, that's horrible, right? That's like a that's not. I mean, to me that's great. Some people might think that's amazing, right? But and you should probably everyone should have some cash in a account like that, right? Whether it's with them or somebody else, you got to have some type of liquidity in that kind of account. If you're putting in a savings account, you might as well put in a high yield savings account.
Yeah.
But I'm looking at it like, oh, I can double or triple that without even thinking, right? And without even having any risk involved in losing any money, right? Because everything's gonna be backed by an asset. So, I mean, I think that's kind of the beauty about private lending, right? Like you use it all the time, right? In your side.
Yeah.
Right?
I mean, almost every deal we have when we first start is going to be private. We buy it. That's kind of like where I was kind of wanting to go with it, is that really, like, for me personally, I like to talk to Jeff because he's actually doing deals right now where personally we've slowed down, not because of the economy or where we think things are going. I actually think that the louder the noise is, the better the time is to buy.
Yeah.
And I mean, if you look at COVID, I don't think it could be any louder than that. And you would have done very well if you would have bought anything in COVID during COVID.
For sure. For sure. Yeah. I mean, that's why we bought our short-term rental. It was in COVID, and it ended up being the best thing we ever did. So yeah, or one of the best things, obviously, right? But yeah. You're right. I mean, so tell me, your portfolio right now, like where are you guys at? What's going on with your portfolio? Because you said it's slowed down a little bit, right, as far as your acquisition side, but like what do you focus on?
So I've mentioned this on other podcasts, but we have so we started in end of 2023. We ended the year with 350 units, and we ended the 2024 year with 650 units.
Wait, say that again. You started with how many? 50?
350.
Okay, 350.
And we added 300 more units on.
That's amazing. That's huge.
And
you doubled your growth, man. That's amazing.
Yeah. So we, we bought a handful without partners.
Yep.
And one thing I've learned from doing that is that you can buy deals with, just the down payments with no partners, because you don't have to worry about asking partners for money later,
Sure.
because you are the partner. And so what that does is it actually restrains your future cash flow. So like when you're doing like a syndication, you raise all the capital on the front end. You don't have to come up with more capital later, ideally. I mean, there's some that might have other scenarios, but I would say for us, ideally, as a general partner, we don't ask for more capital later. It's a possibility, but the goal is to not do that. With buying your own deals, it's constantly asking for money from you.
So
And
from yourself, right? You're capital calling yourself. Yeah. Yeah.
So in reality, looking back, we could have probably continued to grow after this year or after 2024, but it turns into where we bought like about 108 units on our own.
Yeah.
And it's needs a lot of capital, a lot of value add, and we're kind of funneling all of our cash flow into those deals. And so we're kind of just sitting back, managing correctly. We have 100,000 of vacancy right now today.
Wow.
It fluctuates, but we have about 20 people in evictions. So that's coming on the back end. Not all of it's our portfolio, but at the same time, it's like it has nothing to do with the economy. It just happens to do with our operations and us, the type of parks that we buy. And we are buying a lot of value add stuff. So it's like, maybe a few people have lost their jobs, but I think it's really just the overall, we bought a bunch of rough parks and we're turning them around to make them nice. And those evictions are very expensive afterwards. You have to you have to replace the subfloor, replace, add on roofs and put kitchens, bathrooms in, a lot of them. So it's about 10 to 15,000 per renovation. Yeah. And if you have 20 of those coming.
Are you guys still doing like your business model, right? Taking those, you don't want to own the actual modular home, right? You want to pass that off to either the tenant or somebody else to own it, right? Where you just lease the pad, right? That's really what you want ultimately.
Yeah.
So
you're offsetting the liability, but to get the best resident in there, we make them nice.
Yeah.
We new subfloor, new obviously flooring, and we spend about 10 to 15,000 in stronger markets. Like we have one in the middle of Tampa where we just pretty much gave them away for 5 to 10,000 as is, and we had like handyman special type deals. Those were easier to just give away as is, and they make them super nice. But with the ones out in more of the rural locations, we had to put money into them. And we generally get our money we sell them for 20 to 25,000 a piece, rent to own. So we're still recouping some of our cash, but through rent to own payments. But we get a $3,000 to $5,000 down payment to recoup some of it, and then that way the tenant has some skin in the game to take care of their units, not want to be evicted, and to take care of themselves. So
are you able to do like a seller finance on that, where they kind of take the note, or is it more like here's your lease to own, rent to own kind of thing? Like what's more efficient for you, right?
Well, I'm told that you can do like seller finance, but I think with the type of age of homes, you can't go out and have like investors come in behind you to hold notes.
Sure.
These are just rent to own payments that are pretty much on the mobile home park's balance sheet, and we charge 0% because that way, if there is issues, it's not a foreclosure. It's just it's more of an eviction process as like a landlord.
Gotcha. Yeah.
But if we charge interest, we have to follow certain rules for evictions, and there's more regulations. So
yeah, that makes sense. So yeah, I mean, and also if you can advertise it, we're like, hey, rent to own, or it's 0% financing, right? I mean,
exactly.
Somebody looks at that, they're like, wow, I can do that versus going over and trying to get 8% right now on a loan, or which they might not even be qualified for, right? So that's beautiful. Yeah, it's awesome. And plus, then you can charge that portion of it, then also the pad portion. So you kind of have a two-way.
You kind of have control over the pad rents because you're rolling them out. If you bought like all tenant-owned homes, then you would say if the rents are at 300, 400, and you're trying to get them to 600 to 700, you have to do that over the course of 2 or 3 years, compared to initially establishing the higher lot rents on top of the rent to own. So you have to really put a value on like what is the lot rent you want compared to what is the mobile home value. And to us, the mobile home value is very little compared to what the actual mobile home park is. So we try to put as much as we can on the lot rent just to keep the value in the mobile home park and not just give away equity inside of the mobile homes themselves.
Yeah, that makes sense. I mean, I think it's a great business model. And like I said, you got a decent amount coming through eviction right now, which is obviously some bad debt that you got to get rid of. And, anytime you buy value add, right, that's going to happen, right? So, I mean, whether it's a mobile home park or it's a industrial complex or even an apartment complex, right? We deal with that, with our apartment complex, and we buy value add, right? We know we're assuming some some liability of bad debt, right? So we have to take a look at that and understand what is our game plan in order to make sure we can quickly remove that, right? And we've done some things where instead of it being like a full eviction, we're just going to say, hey, you were on a month to month. We're just not renewing your lease, right? I mean,
That's what
we're allowed
we put
to do
everybody
that,
on month
right?
to month.
So you're on a month to month already, and you weren't paying rent to the previous person. So now you're not going to pay rent. We know you're not paying rent to us, so we're just not going to renew you. And by the way, you got to go. So it kind of naturally attrition, right? Kind of takes the bad debt out of the park, right, or out of your apartment complex, and then at that point, then you can definitely do your value add. Increase the unit, force the appreciation, get a tenant within your parameters, because you know that the previous owner was just slamming people in there, probably to get occupancy up, right, and not really
put a pulse in. Yeah,
exactly. So we see that a lot, right, and it's sad because a lot of landlords would do that, right, and I don't know, like I always like to kind of make sure that when we buy something, whether it's or even if I go rent a car or something like that, like I'm always going to return it, or I'm always going to sell it in a better status than it was before, right? Mm-hmm. And so I think if you just kind of go with that mentality that, hey, no matter what happens, we're going to be honest, we're going to be upfront, we're going to be, make sure that that we're leaving this planet, or leaving this asset in a better position for the next person, right? There are some people who don't give a shit, right? And they are going to just do the best thing for themselves, and that's it, right? So
it's literally what I would say though is it's like the mom and pop investor, and I will tell you that they actually become very wealthy doing it, but it's through time, not through efforts. And the other thing is that it's unscalable. So you can't go out and buy more units if you have and you're unable to retain good people to work for you as well. Like nobody's going to want to deal with a lot of problems all the time,
Oh yeah,
and
also
they don't see you backing them up.
Yeah,
like me backing up my property manager.
Yeah, exactly. And then banks aren't going to loan to you. If the person's goal is to scale and they're doing it in that way, it's not the right way. But if you're buying new properties, you're fixing them up, you're adding value, you're getting better residents, you're creating a better community for people, and for the not just that localized community, but like around it as well too. The economy around it starts getting better and better. Then I think that's you're doing what's best for that town, right, or that jurisdiction. So I like to think that we're helping the community grow, just as we're growing our own portfolio and our own wealth as well too, right?
I also, the thing about quote unquote the slumlord, I actually don't think people become slumlords overnight. I just think that it's just through bad systems that they just become tired of doing it, and they end up just saying, like, I'll tell you, this is how it worked for us, is that we originally had like 400 units, a big portion of them as park-owned homes, and we could see the top line revenue being very high because of the park-owned homes. We're not like selling the mobile homes. We're not reducing our revenue by getting rid of the mobile homes and getting lot rents. We were like, why would we lower our revenue when we could just hold on to them?
Yeah.
But what I had found is that once you measure that stuff over time, you start to realize that owning the mobile homes actually drives down your overall net operating income. So, but what would happen is we were putting, like, say, the same thing we're doing now, spending about $10,000-$15,000 in a renovation, holding on to them, not selling them.
Yeah.
And then the tenant would turn over, and then you would find yourself spending $5,000 to $7,000 on the renovations. And I'm like, I don't want to spend anything on this right now.
Exactly.
And you're like, how about we just get somebody in there as is? It's like, we never did that, but that's how my mentality was like starting to become. And I was like, this is how you become a slumlord.
That's exactly,
And this is what we have to do. We have to screen better, which I think we were screening. It's just that the type of, with the renter and the ownership, there's a different type of mentality for the resident. We have to, the idea is screen better, or screen the same, but also have the tenant become an owner. That's how it became for us, and that's how it became where our park started getting nicer through doing that.
Yeah, I mean, if you provide ownership, right, and then they see that as, hey, this is not just a rental for me. This is like my home. This is my ownership, and my neighbor. I want my neighbors to be better. And eventually, they start cutting their grass, and everybody starts cutting their own grass, and all of a sudden, you've got a nice, beautiful neighborhood. You see it in areas where that doesn't happen, and they don't take that ownership to heart, and all of a sudden things kind of fall apart, and they don't care anymore. And like I said, every time if you're a landlord, let's say you're a single family rental landlord, right? Because I've got a couple single families that I could easily fall into this trap as well too, where you have to do an eviction, or somebody moves out, and it's a yearly thing, and every single year you're spending $4 or $5 grand to rehab or to fix up that apartment, and you only cash flowed $3 grand for the year, right? You're wiping out your profits every time you change somebody over, right? So the goal is to screen better, get a longer term tenant, get someone who's going to be in there for 4 or 5, 6, 7 years, and also provide them some type of way to to understand that hey, this is yours, right? You can stay here for a long time, right, and take some ownership in it, or like I said, the ownership or lease to own is a beautiful way to go about it. So Glenn, I think that's a great way to continue to grow your portfolio and wealth, and also then make sure you have your residents, or who are living there, take ownership in the area as well too.
Hey guys, if you want to learn more about our deals we're investing in, go to our website and sign up for our free ebook, 10 Reasons Mobile Home Parks Outperform Other Real Estate Investments. We won't spam you. We'll just keep you updated on the podcast and the deals we're working on. Now, back to the show. So let's talk about Jeff's portfolio. I think the one thing I would say is his is more blended. It's not all one asset, but I would say that we can talk about the pros and cons for all of them, or maybe more of the pros.
Sure.
There's probably some cons, but I would say that...
well, there's cons in every investment.
Yes,
I'm
of
not going
course.
to sit here and say everything is sunshines and rainbows, right? So,
Yep.
but we've got our portfolio is more multifamily. So, but for me, selfishly, I'm like, hey, listen, I want to invest in ground up development. I want to invest in single families. I want to invest in industrial and so forth. So we've kind of have a very good blend, right, between value add multifamily, ground up development for some good Class A right in your backyard, right in St. Pete. We've got
Nice.
we've got 3 projects that we're about to break ground on one of them here in the next few months, and then another one about 7 or 8 months after that. So
How's interest rates affected that project?
so we're looking for construction loans, right? And so when you look for a construction loan, it's based on the total outlay, right, not the total loan value, right?
Mhm.
And we're also interviewing and vetting a few partners, right, who would actually come in and be that debt and equity portion of it, like a family office, right, or a larger fund. So we might not even have to go through the traditional lending route on that, right? So which is beautiful, because that helps us, both ways, because then it provides that person a good return on their money, and also they're in it as equity as well too, right? So
I have a great introduction for you, and they're right in the center of downtown St. Pete. They just did a bridge loan for us, but I think that they would be the perfect lender for you over in that area.
Definitely love to do that. Yeah, so
Definitely.
we've got that going on for our ground up development deals, and we have our value add, just like we've talked about the value add side, and all of these have different pay schedules, so to speak, right? Different depreciation schedules, different equity schedules, exit schedules. And then we have our industrial portfolio, which is amazing, that we're actually about to sell our half of it, right? So we've got a warehouse that we're flipping, that we're selling, should be closing end of this month, once the billboard company decides if they're going to buy the land or not. But once we get that closed, that'll be excellent. So our investors will be able to get their exit returns.
Excellent. Yes, I like that one.
Excellent. Yes, exactly. Which is amazing. I mean, it's great to have an exit going on right now as well. So we're doing that, and then one of our what we're also seeing in the market too is that there's a need for investors who are looking for cash flow, right? And a lot of the deals today are not cash flowing, right? Meaning that they're equity heavy deals, right? So you got deals that are your value adds, even some good Class A deals and so forth. They're not in a position that they could potentially provide cash flow day one, right? So we looked at that and we said, hey, what's the next step in a an investment or alternative investment that we could provide a good cash flow asset, as well as provide value to our partners. And I'm actually doing this in a different fashion. So I've talked about it before, is private lending, and we were just talking about it earlier, right? Private lending is you got non-bank lenders, right? Whether they're a fund or a private person, whether it's a singular deal or it's a fund option, where you can get financing, faster. You can get vetted and proved much better, and it's also still backed by an asset, right? So we're launching a private credit fund, and we find that this is a good position, a good opportunity to be able to provide consistent cash flow to our investors, right? So we're going to have a monthly distribution, right? So day one, you start accruing interest, right? And after your first month it's kind of just like a loan, right? After the first month, we'll pay a monthly distribution. And then from there, you'll also accrue a certain amount of distribution, or accrue interest annually, right? Until we have an exit, right? Until it's either a refinance of that property, or it's a sale of the property, right? And we're going to have multiple deals inside one property or inside one fund. So we've already got lined up 2 good, amazing Class A assets in Houston that are already cash flowing, just need a little bit of infusion to refinance out of their old debt into some good debt. And so we're going to be sitting literally right behind them in a subordinate position. And it'll be able to cash flow on the actual operations of the property. So the properties are that we look for, right? We look for a few good things, right? We look for really strong operators, right, of properties.
Yep.
They have to be in a position to cash flow right now, right? We look for certain things like tax abatements, certain strategy we can provide to be able to greatly reduce either expenses or increase the operating income. And so if we can kind of combine those 2 things, we're able to, and we're sitting in a position that's before equity, right? So we're not sitting, so you got the senior debt of the capital stack.
Yep.
You've got your common equity or prep equity. We're sitting in between that, right? So it's getting paid on a monthly basis.
So it's more like mezzanine. Is it considered mezzanine?
Mezzanine debt. It's very similar to that, right? We call it private credit, right? But it's very similar to that. And the opportunity is being able to get consistent cash flow and then accrue a good back end. So we're looking up to 14% preferred returns
Nice.
to our investors on these deals, and they're going to be probably more like a 3-year hold, 3 to 5 year hold, right? So so it's a good hedge, right? Because a lot of investors right now are not getting cash flow from the deals that they're in, but they're getting depreciation, right? And if you are a W-2 employee and you've got depreciation coming in, what are you gonna do with it? You really can't. You can't utilize it against your taxes unless you're a real estate professional. So they're looking for opportunities to provide cash flow, right? And if you've got investments in multifamily, you're getting depreciation, and you've got investment in our private credit fund where you're getting cash flow.
Yep.
You can take your depreciations and offset this passive income, right?
Yep.
So you get a good 6% actual return annually, right? Plus our accrued, right, which is up to 8%. So that gives us a good 14% return over the life of the period, right? So it's really nice.
Yep, it's kind of similar to what I also do personally, but the depreciation is a good part. Is like if you have a little bit or if you have equity in one side, you can recapture it on another deal because of the I guess it's considered passive income.
Yeah.
Obviously, this isn't tax advice. Talk to your accountant, but
exactly. We're not tax guys, right? But yes, but we know a thing or two. But we're go talk to your legal professional for that one, right? But,
enough to be dangerous.
Yeah, enough to be dangerous. Yeah. And also, on this deal too, you do have to be a accredited investor as well too, right? So so we are looking for folks who are interested, who have some equity in certain positions, but maybe not getting cash flow or looking for a cash flow opportunity. And this is a great best of both worlds almost, right? So we're really excited about it.
So what happens? I've seen this with a few debt funds. Is there like any kind of liquidity, or is it you're locked in for the 2 to 3 years? Is that what the plan is?
Yeah, well, ours is going to be a 2 to 3 year, or probably 3 year hold, right? Because we want to be able to provide a good, sustainable return for it. We haven't put it in a spot where you can recapture your money or take your money back out, but there's we just have to look to see how that works out in the future. But for right now, right, we're doing more of a 3-year hold.
Yeah, that's one thing I've seen on some of the debt funds, but the interest rate's a lot lower. The preferred return, I think it was like 8 or 9%, but it was like a 90-day liquidity portion, but you're obviously not getting as much return. So, but if you have plenty of depreciation, it's great to put it into something that's able to capture that on the 14% for sure.
Yeah, exactly. And it's again, I think the biggest reason why we looked at this, we looked at the market, kind of what has been happening for a lot of deals that we've seen, and there are distributions are going to get pushed back a little bit, right? Especially if they're kind of caught up in a bad interest rate, or it's a heavy value add, right? Those sorts of opportunities are going to rely on a refinance or a sale.
Yep.
To meet your preferred returns, which I'm sure they still will. I mean, you'll still, if you've got a good operator, those deals will still have, your probably a good average of 20% return, maybe. But you're going to have to wait a few years to appreciate that, right? Now, again, that's why we looked at it and said, hey, what can we do that provides, a passive return, but it provides a monthly distribution? And I think that's a big thing. So, we see a lot of that right now, and we think it's a good opportunity to do that.
Yeah, definitely. And the thing I like about your portfolio, the blend of it, is that there's multiple areas. It's almost like when you're buying a stock, like an index fund, you have like a small cap, which would be more like I guess we can consider like a value add. And then you have the medium cap, which would be like a class B or C property. and then you do, the development, it's like an A-class property,
Yeah,
and
exactly.
then you have the bonds, which would be, something like what you're talking about right
Private
now.
credit fund. Yeah, I mean, if you can figure out how to get a good diversified portfolio, I mean, that's to me, I think that's the most important thing that a lot of people should focus on.
Yep.
Because if you put all your eggs in one basket, right,
Yep.
and that one basket goes up in fire, like up in smoke, what's going to happen?
Yeah.
And then that's where I've lived my entire, my investment career, right, is to diversify as much as possible, provide, different return schedules or different exit schedules, different exit equity schedules, and the tax depreciation schedule. I mean, so if you can get a good pipeline of that moving forward, your wealth and your snowball will just keep on building, right?
Yeah, I was talking to Ryan Norris. He's a big mobile home operator, and I had like a one-on-one with him, and he said something that's been sitting with me for a long time. He's saying, you don't make your money on the income. He's like, you make it on the like the cash out, like the refinance. And he's like, and these are considered like to be tax-free events, like when you or if you roll them over to 1031s and stuff like that. But it's like the way he was saying it was over time you won't need the income because you can live off of the the return of capital type stuff. And
Sure.
and I'm starting to kind of see that now, because this year, even with the interest rates being high, I have like 2 or 3 events that are going to happen this year that we're working on. We did one that we just had. We just did a $4 million refinance through the lender I'm going to introduce you to. I think they're perfect.
Yeah.
I could tell you that lender, they were in the middle of downtown St. Pete, and they were showing me all the projects that they're financing. It's all development projects. So
That's
it's a great lender, as I'll tell you. But we did 4 million there. So we got a little bit of cash back there. We have a new one that's coming up in the pipeline that's going to get about it's a $500,000 to $700,000 return of capital, which I'll probably receive about $50,000 myself, and and have full cycle deals. So like my plan for this year is just to start showing some full cycle deals when everybody's reading bad stuff on the news. Let's show some full cycle deals in the middle of it.
Yes,
and you'll be able to have unlimited capital after that.
Yeah. No, it's amazing. Yeah, if you can kind of get into that cycle where you do have to consistently buy. So you have to buy. Right?
Exactly.
You have to be able to fix those up, and then you get into like a 3-year cycle where every 3 years you're either selling or refinancing a property. Then you can have that good capital event, which continues to build up your portfolio, and then you recycle that money. So I think what you mentioned earlier about you don't live off of your cash flow, right? Because you do want to be able to utilize the cash flow in order to pay for your bills, right? And do certain things that you need to do, right? And maybe you're putting it into a slush fund, like a fund that you can go and use that for your vacation fund or something like that, right? But you will have if you build your portfolio right, you will have a good mix of monthly and quarterly distributions and annual distributions, right?
Yep.
And which are your annual ones could be your sales and refinances, and then your monthly and quarterlies are your cash flow that comes off of those properties, like your dividends, right? So just like anything else, like if I've got, unless you need that dividend to pay your rent or do whatever it is, I'm going to take that dividend and continue to put it back into my properties, right? Until that grows even more, right? I do that with the hard money lending business that I'm a part of, and I'm doing it with a private credit lending business we're a part of, right? So I think it's the best of both worlds if you can have your cash flow reinvest into properties, right, or reinvest into assets while you're continuing to move. Yeah,
it's like you've hit the ultimate cheat code at that point. It starts to become where it's more of capital allocation compared to focusing on the expenses, which I have been on that path for a while, and I'm starting to get to a point where the capital's starting to come back, and starting to figure out a better way. And it's no longer building out the income for myself; it's about to build the asset value of my portfolio.
Excellent. Yeah, no, that's it. So if you've got a portfolio that you can grow consistently while you're recycling your money, or you're preparing that money and the velocity of money, right? And we've talked about that with whole life insurance. We can probably go on another tangent whole life on it, right? But being able to build a good diversified portfolio and have that feed your lifestyle, right, is important, I think. So for most people, right?
Cool.
Yeah.
So Jeff, is there anything else you want to bring up? Any other deals you have going?
No, that's our main thing right now is a private credit fund, right, for credit investors. So if people are interested, they could go to our website. It's valoriscapitalpartners.com. Go check out our deals there, and that's where you can find a private credit fund. And I'll share a link with you as well, Glenn. You can post it on your in your notes here. So I appreciate that too.
Yeah, it's like when even with the market, everybody, you see a lot with the stock market. It's going it sounds like it's going down. I don't know. I don't really follow the stock market too closely, but I'm hearing in the background about the stock market.
Yeah.
And you always think to yourself, if you could prevent a loss and get a gain in the middle of a loss, you've actually won.
Oh yeah, for sure.
Drastically. It's like if everybody loses in the stock market by 20% and you were able to maintain a 10 to 12% return over that time frame, you have an alpha of like 30% in that time frame. So you've actually, that you're just trying to beat the market averages. So
yeah. I mean, and the market actually has been doing pretty good recently. It's kind of it took a dip when those tariffs were, there was uncertainty around the tariffs, and now it's kind of stabilized a little bit, but it could go back again, right? And so anytime you have a down market is when you should be buying, right? So whether it's in real estate or equities, but there's that's a portion of someone's portfolio, right? Not the full picture, right? So another portion, could be something that provides the consistent income, right? Like a private credit fund, right? So
Definitely.
I'm excited about that, and I think we're going to have a really good turnout for this one. And so if anybody's interested, let me know. We'll have a conversation.
Definitely. Thanks so much for being on the show,
Glenn. I appreciate the time, man. Looking forward to seeing you again.
All right, thank you.
See ya.
Thank you for listening to the Millionaire Journey podcast. Please rate, like, subscribe, leave a comment, and share with somebody you think would enjoy listening.